Welcome to Hedge Fund Tips with Tom Hayes. I'm Tom Hayes, and this is your 153rd VideoCast, 143rd podcast for the week ending September 22nd, 2022. We're going to quickly do the media. I want to thank Hannah Doba, Ali Thompson, Ellie Park, Lisa Farkas, and Joe Cole for having me on Cheddar on Friday. And want to thank... right here, Hannah Viviers, Samuel Kantai, and Lucia Moki for having me on CGTN Africa on Tuesday. So we'll go into those a little bit later. Also want to thank Ellen Chang for including me in her article on thestreet.com about tech and the IPO markets and when they're going to clear, as well as Devik Jain for including me in his article on Reuters yesterday after the Fed announcement. So I want to start with a little bit, one of the Ask Me Anything questions this week, and we'll do the rest at the end. But JT Investor sent this note, which I'm sure is all on your mind. Tom, your latest update clearly expresses a concern about the Fed's guidance and the increasing potential for a hard landing. It seems like your outlook has gotten significantly more negative after receiving the last Fed guidance yesterday. Could you please elaborate on your latest thinking on where markets are heading for 4Q and if you're changing anything in your investment strategy? Thank you for being a voice of clarity for your followers. I would say this, JT. We're going to walk through the facts because on the face of it, what they said yesterday was very negative. However, when I look dispassionately at all of the data, and we're going to go through some of the things that I look at on a regular basis, I can't put my finger on what is going to turn this back around and turn it back around abruptly into year end. But I can point to the fact that everything's lined up that should be the case. So maybe we'll have some hints as to what turns it around after such hawkish talk and kind of reckless guidance. And it may be something that they can't even control, and something that we don't know. But, you know, I've been to this movie too many times before to know that when things become this acute, something always comes out of the blue and turns the sentiment and the tide very, very quickly and catches a lot of people offside. Because there's no one right now on Wall Street or elsewhere on TV or anywhere else that's credible that has a positive outlook. Everyone has all gotten to one side of the boat, and we're going to dissect that, largely justifiably so in many cases. But that's not how you make your money betting with consensus. And as a matter of fact, we're going to get to a few quotes of the week here from Ray Dalio. First one here I have is the average man tends to buy high and sell low. Why is that? What if everyone knows you should buy low and sell high, why does everyone buy high and sell low? And the answer is people buy when everyone else is doing it. It's much easier. As a matter of fact, I was speaking to a reporter today, and she said that her friend wanted to buy a house because everyone was buying houses. And I said, I can't even begin to understand that logic of wanting to buy because everyone else is buy. For me, it's just the opposite. When everyone's buying something, I'm like, okay, it's not the time for that. What can we look at that's high quality, that's out of favor? It's just, it's literally in my DNA. But I think the reason people do that is they buy when there's euphoria, like let's call it December of last year and some of those tech stocks and ARC innovation and all that stuff. And then they sell in periods like now when everything looks grim and they're just saying, I can't take any more pain. And they just puke at the absolute wrong time. And they do that over and over and over. And it's just, I guess it's just human nature is the answer to the question. The other thing that Ray says is to make money in the markets, you have to think independently and you have to be humble. There are very few independent thinkers in this business. And to do that well, you have to be humble in those periods where it just takes time for the thesis to play out and you just have to stick with it. Most people just bail, they sell out, they don't talk about it anymore, they go on to the next consensus idea, et cetera, et cetera, et cetera, and they never have any outperformance at any periods in their career, and they're just basically closet indexers. So, during periods when it's tough, when it's just not moving at all, and you're kind of in this holding pattern, you just have to be humble. You just have to bide your time. You just have to know that all great fortunes have been made by biding your time in periods when no one else wanted to be there. And then sure enough, when everyone wants to be there, that's when you start to lay off the assets. So I thought these were timely and correct. And then finally, in order to be successful, you're betting against the consensus and you have to be right. And for most of the bets, and I've looked throughout my career, it's for me, it's always just been a question of time arbitrage. The theses always play out. It's just a question of time. Sometimes they play out in months. Sometimes it takes a few years. But invariably, if you're buying high quality assets when they're marked down, you're going to make multi-baggers over time. Speaking of multi-baggers, the other guy sent me a question, Michael Chu. Hi, Tom. Great podcast. I hope the golf will soon be on the same level as your hedge fund tips. Yeah, well, it's getting there. The driver has become a machine. I'm hitting it straight and I'm hitting it long. I got this thing called Acros where you put these things in the back of your club and it tracks every single shot, every single club, greens in regulation, tells you where your, strokes gained, etc. Fully analytical. The driver, I'm gaining like 2.5 strokes every round, like that. That's working. Got to get chipping's getting better, putting's getting better. So it's coming together. You can look up my handicap and scores on GHIN, GHIN, for all of you golfers, and you can tell me if you think the trend is in the right direction. But leaving that aside, I wanted to ask, okay, I'm not in the trade. I'm a home investor, but don't have a strategy in taking profits, and I watch them disappear. I always hear you talk about multi-baggers. If I have a company I really like, is it simply offload some and not watch them over the very long term, 10 years? And thinking how much the likes of Microsoft has grown over such a period. Any related podcast articles? Okay, so I always know when I'm getting out before I get in. And that comes from doing deep fundamental analysis. So I would say, first and foremost, read The Intelligent Investor by Ben Graham. Start there. See if you have the capacity, aptitude, and interest to even develop those skills, to have that type of conviction in the things that you invest in. Then read all the Buffett annual letters, then read security analysis, and then from there you'll know if you want to spend your time doing that or if you just want to lay it off and outsource it to someone else. So for me, for instance, for like Cooper Standard, I know I'm not going to telegraph to the world when I'm getting out, but I know where we're going to get out of the first third of the stock. I know where we're going to get out of the second third of the stock, and I know where we're going to hold probably for many, many years. And the reason is that you have to recognize that anything can happen, but when you have a clarity around intrinsic value, I never get fully into a stock all in one tranche, and I never get fully out of a stock all in one tranche. If I say XYZ is worth $150 a share, I'm not going to say I won't sell a share at $149.50 and be rigid. I'll probably take off, if the stock's at $5 or $10, I'll probably take off, a third, at some level that I think is like the low end of their historic multiple range, and a big haircut on what I think their earnings power is. Then I'll take the second third off at kind of a normalized multiple with normalized realistic earnings, and then I'll take the third off with complete upside potential and let that run for a while and let time work in my advantage, particularly if it's a company that compounds capital on an internal basis at a above market rate of return. Why would I let that go? So, and that comes to knowing how to do fundamental analysis. If you're just buying stocks and hoping that they go up, you should just, outsource it or develop your skills more, because you never start a battle before you know you have a game plan and you have things mapped out, and you consider all possible contingencies. What will you do if this happens? What will you do if that happens, etc. And you saw that in Russia. I mean, Putin underestimated NATO's come to defense and funding Ukraine with weaponry, with funding, et cetera, et cetera, et cetera. And that's why this has gone on. And I think that, by the way, that could be one of those white swans where you get into winter, Europe and Ukraine and everyone, they start to get a little bit antsy about energy prices, and maybe that forces a negotiation. Putin's weak. He started this draft, basically, and now all these Russian men are getting out of the countries. The moms are not supportive because all the body bags are coming home. So there are a lot of things in flux that could lead to some type of negotiated settlement. We'll see this vote in the separatist region, how that plays out. But there's no upside priced in that anything could go right over there. Realistically so, but that's often when things happen that you can't understand. So just looking at, and we've gone through these a few times, but it goes without saying, these become at levels where you get paid to take the other side. The 10-day put call ratio is at an extreme. Everyone's buying insurance when the house is already burned down. NYSE volume index, again, this is areas where you want to be a buyer. Same thing with NDX, 1% EMA of the advanced decline ratio. I mean, this is, these are real extremes. If you go back many years, I mean, this is worse than the pandemic. And it's, we have like a growth problem, 2015, 2016. I mean, these are all levels where if you bought, you made huge money over the next few years. Now you could say, well, this time is different because the Fed is tightening, etc. But if you recall, the tightening cycle was starting in earnest here in early 2016, the last time you got signals like this, and that's the result you got. So over and over, what we're seeing is indications that things are at an extreme and it's time to buy. And that's often the hardest time because, like, literally, I can find nothing positive in any of the media, in any of the commentators, in any of the press conferences this week, etc., that makes you want to be a buyer. And the last time I had this type of feeling and kind of this distaste, knowing it was time to be a buyer, but not being able to point to any thing that was going to catalyze it, but just knowing that based on all the metrics we look at, if you buy, you get paid. If you sell, you lose, was June, okay? And all these things were pointing to the exact same direction in June when people were this pessimistic. Here's the PMO by all. Like I said, this can stretch on a little bit, but invariably it always goes back up, and that pays well. Buy DJI. So maybe we go down and test the lows. I wasn't in that camp. It looks like we may be headed in that direction, but you still got about 3.5% to get there. We'll see. The Fed is speaking tomorrow. If he kind of signals any flexibility. I mean, what I would simply say is we did 3 emergency hikes, 75, 75, 75. On the basis where inflation numbers were this month, we're going to go to 4.6. But if the data changes in the next 2 months, we have to remain flexible. We were wrong about our estimates every single meeting for the last 2 years. So we have to retain enough humility to say if the facts change, we'll change our minds. That's all he really needs to communicate. What he communicated yesterday was more like the December, it's on autopilot, that's where we're going, highway to hell, and that's when, Mnuchin had to come in and bail him out. Unfortunately, Mnuchin is no longer working in this administration, so, maybe you have Janet Yellen, who is a solid Fed pres, but Fed chairwoman, but that's kind of where it is. So we'll see if we get any kind of walk back in terms of flexibility. If we don't, at these levels, though, it's really hard. You're just out of sellers. Look at this bullish percent NASDAQ composite. This is percent on point and figure buy signals. We don't use point and figure, but we do use this to get a sense of different sectors. And, you're at levels where you wanted to be buying. And these were extreme situations. The credit markets froze up in 2015 and 2016, the high yield credit market. That was a much worse situation than we're facing today. Financials, same thing. So some of these could go down further before they bottom. Healthcare, but these are getting towards extreme levels across the board here on the technology sector. I mean, it's approaching pandemic lows. It's worse than the debt crisis in Europe in 2011. So you have to look at these things and say, if you're not a buyer at these level of extremes, why are you in the business, and how are you ever going to outperform if you're not stepping in when everyone's puking out? And that's really what it comes down to. Materials, same thing, NASDAQ. So some of these can go a little bit further. The bullish percent real estate. This thing is completely washed out. People say, well, of course it's washed out. Rates are going up, but real estate's been an inflation hedge. They can raise rents, and you've had these other periods, the beginning of the last tightening cycle, the middle of the last tightening cycle, same type of washout, and you got paid to buy it. Let's see. So we just go through those over and over and over, and then this is very interesting. So this was from Market Watch, Barbara Kohlmeier. She says, our call of the day comes from Julian Emanuel at Evercore ISI. He's the chief equity and quantitative strategist. They're a good shop. That's Ed Hyman's old shop. He's probably the best economist in the country. And Emanuel tells clients in a note, the Fed could and should guide the markets on Wednesday that the data dependency for the central bank's November 1st to the 2nd FOMC decision is 0 to 75 basis points, not 50 to 75. They didn't do that. Maybe they'll back it up tomorrow at the Fed, quote unquote, listens meeting tomorrow. But given that the Fed will be assessing enormous tightening already in place and potential for messy midterm elections, the strategist thinks the dollar will continue to temper its strength. The dollar index is about up 1.3% in September after a blistering 2.6% gain. Evercore team offers up a list of dollar down denominators names that could outperform in the case of a dollar pullback. So they're making a list of things to buy as the dollar weakens. And what they're pointing to is a technical signal called an RSI negative divergence, meaning the US dollar has been going up while the relative strength and the buying power has been weakening, and that usually converges with the instrument matching the relative strength, and they're saying basically buying momentum is dying out. We agree. We get to that conclusion a different way. So what he said is, which city strategists have described as one of the only places to hide. While the greenback is looking overvalued and a turning point inevitable, city says either global growth expectations need to turn or the Fed needs to pivot for that to happen. So, the one thing that I covered on, I think it was Cheddar and also on CGTN Africa, was that people are underestimating the amount of stimulus that has gone into China in the last 6 months. And now COVID zero seems to be winding down. The country's reopening. You saw the economic data come in, the recent numbers this week in August, much better than expected. You're seeing other anecdotes we're going to cover, C-Trip, huge amount of travel bookings, etc. So the consumer is coming back in China. And I think the world has just written off China. China has been an engine of growth historically, and as that country reopens, all the stimulus from November and March that I've been talking about is going to all come at once, and I think it's going to be abrupt. I think it's going to be massive, and that may effectively bail the world out of a global recession. I mean, Europe, you can't count on regions that are dependent on the kindness of strangers as it relates to energy. So Europe is still very vulnerable. But if I'm right about China, that demand, could help Europe weather some things. And then if you get, some type of lucky break with Ukraine, et cetera, something that's no one's expecting, that would be a catalyst. But the point that I'm trying to make is I can't put my finger on what would turn things around from such gloominess and bad guidance and bad decisions, other than when all these conditions lined up in the past with this extreme pessimism, selling pressure, positioning, etc., The pain trade was the other way. The pain trade became up because everyone was positioned for lower. Everyone sold out of their stocks. Everyone's had their margin calls, their crypto calls, their et cetera, et cetera, et cetera, the people that traded on leverage. So the worst thing that could happen right now is some unexpected good news. No one is positioned for good news. And it would catch people so offsides. And they're so negative right now that they wouldn't believe the first 8 to 10% move. And they would wait for a retest of the lows that would never come. And that's the textbook case. And we'll see how that plays out. Looking at commodities, nothing's changed. I mean, you got this blow off in the dollar because of the Fed. But, this is the green line here. This is commercials. If you can find an instance where they've been this short that it didn't eventually lead to a rollover, last time here, a rollover, here, it stopped going up and then eventually rolled over. All we need is for it to stop going up, and your emerging markets are going to go bananas. Here, even you got the pullback, here, pullback, here, huge correction, here, a huge correction, here, a huge correction. So, it's time arbitrage. You just have to be patient and humble. These things do eventually play out. So sometimes your best ideas play out in months. Sometimes they take a couple of years. But if you've got it right and there's a large enough margin of safety and there's a multi-bagger in the trade, whether it's months or years is immaterial. You'll get the outperformance over time. And then you look at like the euro, which no one can say anything positive about because why? There's going to be this huge energy thing this winter and they're going to be in a Great Depression, et cetera, et cetera. Except, the commercials are hedged here. They're long. And every time they got that long, sooner or later, you got a huge bounce, or it stopped going down and a rally, stopped going down and rally, huge rally. So could it go lower before it goes higher? Of course it can do that. But I just go through these things and I just try to burden myself dispassionately. Like, I'm not attached to any of these things. I just look at how does it behave in the past when the smart money are positioned in a certain way. And, invariably, the Japanese started defending the yen and they're having a little success. Well, commercials are positioned for that. Whether they're successful or not, I don't know. Like, I wouldn't be long the yen per se, but, I also wouldn't be long the dollar. That's for sure. I would not be long the dollar at these levels after this move, even if it moves a little higher. I want to be positioned in things, not short the dollar, but positioned in things that will benefit as the dollar stops going up, goes sideways, and even, God forbid, even goes down. And then emerging markets would be an absolute rocket ship, China, et cetera, et cetera, et cetera. So again, we're patient, we're humble, we're waiting, and these things inevitably play out over time. So we're not going to go through every single commodity, but the story is positive. Now, what else could it be? The Committee for a Responsible Federal Budget said another jumbo Fed hike is poised to add $2.1 trillion to national debt, according to the CRFB. And that's what I've been saying. Every percentage point increase is about $285 billion a year. They're talking about $2 trillion added to the national debt over the next 10 years. And I think this narrative is going to start to build. And I think they have to be cognizant that the debt to GDP ratio in 1981, when Volcker went crazy, was nothing like it is today. They don't have that runway that Volcker had to raise it up to double digits to kill inflation overnight. They, in effect, need the exact opposite. They need inflation to run above trend, 3 to 5%. On average over the next 3 to 5 years to get debt to GDP down to normalized levels like they did post-World War II. So for everyone that keeps talking about, Jay Powell has Volcker's book on his desk, like, who gives who cares, okay? That's irrelevant. At some point, this is going to be a huge factor. And by the way, in effect, if this narrative gets legs and people realize the impact of these hikes on a country that has over 120% debt to GDP, that could be the thing that drives the dollar down and drives the dollar down extremely quickly, in which case emerging markets will absolutely fly. So the narrative is starting. People are becoming more and more cognizant. They must be followers of my podcast or just independent thinkers themselves. And we'll see how this plays out. But I think that's what people are missing in that simplistic comparison between now and 1981 and Volcker and all that stuff. The other thing is people often look at retail investors being the dumb money. It hasn't been the case since the pandemic. As a matter of fact, institutions have been the ones selling in the hole consistently. And what we're seeing is they're doing the exact same thing again. Institutional investors flee stocks as inflation fears drive selling to its highest in 2022, while retail investors remain buyers overall. So they're dumping in the hole. And this is the exact same thing that was happened during the pandemic lows. You saw a huge puking out from institutional investors, and retailers were actually buying in the hole. And the same thing is happening right now. So again, it's humility and time. And sure enough, these things work out. And when you measure enough of these indicators over time, you know when the odds are in your favor. Nothing's ever absolute. Otherwise, we could pinpoint it to the hour when it's going to change. But, when the weight of the evidence starts to point to things are at extreme and you can't put your finger on, well, what's going to possibly turn it around, go to the weight of the evidence. Sure enough, something shows up, and it's just like sentiment can change overnight. Ford indicated this week that they had $1 billion of additional costs due to parts. Well, who's one of the major beneficiaries of that? The index-based contracts from Cooper Standard. So like I said, we're very pleased with what's happening with the business operations with Cooper Standard. The risk has been the risk since day one. Credit markets are totally closed right now. Rates going up is not helpful. But they are deleveraging their balance sheet like they did the sale of leasebacks. They said in the last quarter they're doing more of those. They've probably got $120 million there. They're going to be cash flow positive this year. Probably do $40-50 million of EBITDA, positive EBITDA before the end of the year. So as you get closer to that debt payment, even if the credit markets remain closed, and I think my sense, and I've been to this movie before, if it's another 4 weeks or whatever, it's kind of immaterial. When credit markets reopen, they reopen really quickly. And my guess is they'll get something done even before the end of the year, even though they've got, a year and change to get something done. So, but they're the beneficiary of these index-based contracts, and they've got the OEMs like Ford and GM are paying up to get the components so they can ship cars, so they can meet their numbers before the end of the year. And for Ford and GM to meet their numbers before the end of the year, Cooper Standard is going to do exceptionally well on an operating basis. So disinflationary wave is building, even as investors anticipate aggressive Fed rate increase, says this economist. This is Paul Ashworth from Chief North America Economist at Capital Economics. I thought this was really interesting. He says, if we're right that inflation will fall back soon, officials will quickly pivot to much smaller hikes. We'll get a lot of inflation data in October before the November meeting. The continued drop in gasoline prices and easing food inflation will weigh on headline CPI over the next month or two, he said, referring to the Consumer Price Index. He also pointed to signs of disinflation in core CPI data, which exclude energy and food. Despite the larger than expected 0.6% rise in core prices in August, there are mounting signs of disinflation there too, he wrote. Supply shortages have normalized. I don't know if we covered last week. There used to be 120 ships waiting outside the port in Long Beach. They're now like 7 or 8 ships and going down quickly. So the supply chain issues are largely a rear view mirror thing. But he says supply shortages have normalized with the firm's product shortage is indicator now suggesting that, quote, core goods inflation could fall back to 2% before the end of the year from 7% in August. Let me tell you something. If we saw 2% down from 7% in the next month, they're not going up to 4.6% unless they're just they're not going up to 4.6%. Now keep in mind, guys, as hawkish as they've been, and as high as inflation's been, as of today, we're only at 3.0 to 3.25, which is historically very, very low. So whether they do that extra 150 basis points before year end, as much as they say they're on autopilot, I would think he's going to signal some flexibility, maybe in tomorrow's meeting, maybe if the market sells a little bit more down to the June lows. But they can't afford another economic crisis. Stock market crises lead to economic crises, and they don't have another multi-trillion dollars to bail things out. So as we approach those June lows, they're not going to want to let it break a lot lower than that before they pivot quickly and before they provide the liquidity needed. They're just trying to bring down demand. They're trying to create this fear. They're being very successful, which is why we get to talk about what they're doing for an hour. So here's their table here. You can see it. And Federal Reserve is aiming to bring down inflation to its 2% target range through monetary tightening that got away earlier this year, crushing bonds and stock. So he's basically making a call that it could get there by the end of the year. I think that's an aggressive call. I do think it's going to be in that direction, and it's going to be better than most people expect. But this is kind of aggressive, and these are some of the white swans that no one is thinking about right now in an environment, precisely like this. Okay, some stuff on China. Las Vegas Sands and Wynn stocks rise on Macau casino recovery hopes. China has reportedly signaled support for Hong Kong's plan to ease COVID restrictions. Hong Kong's chief executive John Lee said he wants to create maximum room for the region to reconnect with the world, with reports suggesting its strict hotel quarantine policy for travelers could be among the first to go. So, look, they're doing the things. It took a little longer than expected, so you got to be humble, you got to be patient. But when you have sound ideas, it's just a question of time. China's central bank cuts 14-day reverse repo rate, steps up cash injections, was about 202 billion yuan, $256 million through the 7-day reverse repos this week. So they're on it. I mean, they're basically opening, and you're going to see what I've been saying for 4 or 5 months, that all the stimulus they're pumping in is going to be felt all at once. And we started to see signs of that in August with the August financial numbers. Goldman Sachs prefers the U.S. stock market. Why? Alibaba is an exception. So basically, Goldman said that, Alibaba's gotten too cheap. Okay. Uncertainty is just so elevated, be it domestic from all the regulations, or even abroad with the SEC auditing issue. He's talking about China. That said, we do think this sector has gotten very beat up. Tough rules, rift. While there's been problems, there's a lot of bad news priced into the sector. I think that the scope for disappointment going forward is much less. I mean, that's about as positive as you could be. It's not as bad, as everyone. It's like they can't even get positive, and that's understandable. It's been 6 months of just a constant drumbeat of bad headlines. And then there's Single Day, an e-commerce holiday in China that could make or break this year when it comes to online sales. That could shift the dial for coming earnings season. So all of these factors, so they don't love it, the region, but they think Alibaba is exceptionally cheap. So that's from Goldman. China spent a record-breaking $8.3 billion on Russian energy in just 1 month as Europe shuns the supplies. So that's the other thing that's keeping inflation relatively subdued in China, is they've got unlimited energy. I know some people in parts of Europe that are buying energy from Russia at a 38% discount. Those countries will do exceptionally well. They will contain inflation better than the rest of Europe this winter. Certainly China and India has been doing that. So, as China reopens, they are in very, very good shape. We've been having to sell our strategic petroleum reserves. They've been filling them up at monster discounts. My guess is their discount is similar to those people that I've been in touch with that are getting, discounts, 38% plus. And that's a positive thing. So, China reacts to Putin's speech, urges immediate ceasefire and dialogue. I think part of that is, demand for Chinese goods has gone down precipitously in Europe and a little bit in the U.S. as a result of the Ukraine war. And China doesn't like it. So they like buying the energy at discounts and storing up their strategic petroleum reserves. They don't like the impact it's having on their economy in an election year. So Xi is starting to put some pressure on Putin, and he has some leverage on Putin. So we'll see how that plays out. Again, another potential white swan. U.S. inspectors arrive in PwC KPMG offices in Hong Kong to review Chinese company audit records, sources say. So that happened this week. So that's all beginning as far as the delisting goes. China meets with Boeing, raising hopes for the 737 MAX flight resumption. So that's a big deal. White swan that's known as paying attention to. End of Hong Kong quarantines, a catalyst for stock rebound after $1.2 trillion U.S. market rout. Here is Hong Kong reopening announced along with pro-consumption policies. Hong Kong government announced ending its hotel quarantine for foreign investors without providing a date on when. Important to note, mainland government agreed to the reopening. This despite Hong Kong registering over 5,500 new Hong Kong COVID cases overnight, as zero COVID is clearly being watered down. This is very important. This is from the guys who run the K-Web ETF, Brendan Ahern. Macau casino stocks and travel plays like C-Trip were up 5.29%, along with Hong Kong internet plays. Okay, here we go. Auto was a strong performer in both Hong Kong and mainland after the National Development and Reform Commission, NDRC, stated policies favoring big-ticket consumption will be introduced. Auto and the EV ecosystem had a strong day. General appliance makers. Remember, 25% of all retail sales flow through e-commerce companies like Alibaba, JD, Pinduoduo, which should help them as well, etc., etc., etc. So, these things are... Politicians always come to the right conclusion after they've exhausted all other possibilities, and I guess they're finally figuring out what they've done hasn't worked. Trip.com, which is a Chinese travel site, says China hotel bookings are surpassing pre-pandemic levels. It really didn't take long for them to come out of things. Once the shutdowns eased, once there was a signal from the government that the game is back on, this is pent-up demand. They're just behind us is basically what it's coming down to. Total domestic hotel bookings was around 20% higher than the 2019 level in July, and we continued to grow over 2019 level in August and achieved hyper-growth versus 2021. Cindy Xiaofan Wang, Chief Financial Officer at Trip.com, said during an earnings call on Thursday morning. So while everyone's got their head under the sand in the U.S., China's coming back online in a roaring way. Exclusive: China sends regulators to Hong Kong to assist U.S. audit inspection. That came out today. That was an exclusive from Reuters. Beijing has sent a team of regulatory officials to Hong Kong to assist the U.S. audit watchdog and with on-site audit inspections involving Chinese companies. 4 people familiar with the matter said as part of a landmark deal between the countries. Now, that's the good news. The other thing that I saw in this article that was helpful was that it said working papers actions that it would take most likely. Here we go. The whole inspection process will last about 8 to 10 weeks, said 2 of the 4 sources, in line with comments by the U.S. SEC Chairman Gary Gensler. Lawmakers made last week. So that would put us into mid-November, right in line with their China National Congress. So, as you get a pop, for those of you, we have some December derivatives we'll roll out. We'll roll up and out as we get the next pop in the stock. The stock we just hold in perpetuity until it gets to our intrinsic value, which we've defined many months ago when we got into the position. And that's that. Japan intervenes to support the yen for the first time since 1998, and they were modestly successful. You can see here the dollar-yen. Okay, as hawkish as it gets, the article of the week, a walk back on the way, ? So, following the pandemic crash and recovery, I gave Chairman Powell and Secretary Mnuchin a lot of credit for saving the world from a global depression by acting quickly and forcefully. As I take a look back, I think Mnuchin deserves all of the credit, and here's why. In December 2018, just after Powell was appointed as Fed chair, he made the rookie mistake of saying quantitative tightening was on autopilot at the December 19th, 2018 press conference. The stock market was already weak going into the conference, but his lack of market experience and savvy led him to believe a hawkish stance at the exact wrong time would make sense. He compounded a 7% pullback in the market to a 16.5% crash in just 4 days following his thoughtless comments. So you can see here, he goes into the meeting. He talks about autopilot for quantitative tightening, and sure enough, the market sells off 10% into Christmas Eve. Steven Mnuchin had to call the CEOs of the 6 largest banks and wrangle up ample liquidity to save a free-falling stock market on a Sunday, the day before Christmas Eve. He put this out, today I convene individual calls, blah, blah, blah. If Secretary Mnuchin had not done that, Powell's amateurish comments could have completely crashed the stock market. The following Friday, Jay Powell walked back his comments at a public event by saying the Fed would be flexible with all of its policy tools, including the balance sheet. So we'll see. I don't know if the market sold off enough today for him to be scared enough tomorrow to walk it back, or he does it a week from now or whatever. But the market rallied back to new highs in coming weeks following the intervention of Mnuchin, followed by the walk back. So Mnuchin saved the day in March of 2020 once again. The $2.2 trillion government rescue, which delivered cash to individuals, small businesses, and giant companies, succeeded because of the program's chief architect, Treasury Secretary Steven Mnuchin. Secretary Mnuchin worked with Democrats and Republicans to devise and pass the landmark stimulus bill. Stress was building in the credit markets, the lifeblood of the modern financial system. Trading of commercial paper, a vital day-to-day source for major corporations, was drying up. Investors were dumping municipal bonds, jeopardizing the ability of states and cities to borrow money to pay employees. Mnuchin also encouraged the Fed to backstop $1 trillion of commercial paper as well as some junk bonds. That was the key, by the way, that turned around the market. The Senate passed the $2.2 trillion CARES Act bill, and the market soared. While Jay Powell learned his lesson of not being too rigid and tight from the December 2018, he overplayed his hand in 2021 when he continued quantitative easing despite home prices soaring as much as 70% in some areas in 18 months. Powell runs the Fed like I play golf. He crushes his driver, but he has no feel around the greens. But unlike me, he seems to have no interest in practicing his short game until it's too late and a colleague has to take over the steering wheel. Unfortunately, Mnuchin is no longer there to tell him what to do. Perhaps Janet Yellen can step in and help steer the ship once again. She was a solid Fed chair. Now, Winston Churchill once said, "Generals are always prepared to fight the last war." Unfortunately, this has been Jay Powell's modus operandi. In 2021, he was too loose, despite the housing and inflation data signaling to pump the brakes a little bit. And he would have only had to pump a little bit at that point to bring it in and get it under control ahead of the curve. But because of his near-death experience in December 2018, he just refused to tighten at all. He was fighting the last war and messed up again. Now he's doing the exact same thing at the exact wrong time. He realizes he was too loose last year, and he is oversteering the economy into a ditch. We've had 2 quarters of negative GDP growth so far this year, a technical recession. The tightening has already worked. He's 50 yards out from the pin, and rather than grabbing his lob wedge and sticking it next to the pin, he's pulling out his driver and pounding it 200 yards past the hole. The time to use the driver was on the tee in 2021, not when you're near the green and you've already destroyed demand. It looks like we'll get a third quarter of negative GDP for Q3. Atlanta GDP now has been falling off a cliff and looks like it did before printing negative in Q2. It's now at 0.3%, down from over 1% just a few weeks ago. So if 2 quarters of negative GDP is no longer a recession, will 3 do the trick? My bet is it will finally be declared a recession somewhere around November 9th, even though it's already happened. Once Biden wakes up and sees how many seats he lost in the House and the recession is declared, they will move to replace Powell. I would anticipate there will not be much resistance on either side. It's been an abysmal failure, and that will be a catalyst for the markets moving forward. The alternative is he pivots beforehand and gets things in order and looks like a hero, but that would make too much sense. We won't hold our breath. Alternatively, if the markets don't get bid in the next day or so, i.e. today, tomorrow, maybe Powell learns from his last 2 failures and walks back his statements on Friday. He is scheduled to speak on Friday afternoon in a virtual conference entitled, quote, Fed Listens. It would be nice if he took a class called, quote, Fed Reads, and figured out when you read the data, it points to deteriorating conditions that are not conducive to further tightening. Just look at the leading economic indicators. Proper interpretation would warrant a mission accomplished speech after already pushing the economy into recession and understanding that inflation, unrelated to war and supply chain, is following the negative growth trajectory on a lagged basis. The proper play would be to say, policy works on a lagged 6 to 9 month basis, and we've just implemented 3 emergency level rate hikes of 75 basis points each. 75 basis points is no joke. 75 of the last 86 have been below 50 basis points hikes since 1983, that is. So to do even one 75 basis point hike is a panic move. 2 is super panic. 3 is super duper panic. And that's what we've done. And what you should say is, we got to give this a minute to work. We're going to now wait and see how the data comes in before making any further moves. Instead of declaring victory and waiting for the data, he made a huge downgrade in the economic outlook yesterday, while at the same time making a huge upgrade in tightening expectations. This makes absolutely no sense. So he took GDP down for the whole year down to 0.2%, which he's basically saying we're in a recession because we've already had 2 negative quarters of GDP growth. And then he took the Fed funds rate expectations up to 4.4%. You literally can't make this stuff up. And, I put a big WTF question mark because it makes zero sense. They were doing the exact opposite last year, which we'll get into. They will have to be walked back. The only question is whether they will require another crash to do so, or if they panic at the June lows and walk it back. The one thing about the Fed is they want to avert another economic crisis that will cost trillions to backstop. They simply don't have the bullets left. Much better to let inflation run slightly above trend than push the economy into a deeper recession. So, we probably have about 3.5% left. Okay, the Dow, the industrials are up. So it looks like the market's up marginally today. So they've got a 4% cushion here before we get into really the danger zone. Fed forecasting track record, just as the Fed underestimated their inflation outlook for 2022 in 2021, they are now overestimating their inflation outlook for 2023 in 2022. Let's take a look at their history of inaccuracy, starting with September 2021 meeting and working forward to today, September 2022. This is not like opinion. This is empirical. So in September 2021, the Fed thought that GDP would be at 3.8% for 2022 and inflation would be down to 2.2% while they continued to ease. They were absolutely wrong. They thought 0.1% would be a good Fed funds rate, with PCE inflation running at that point at 4.2. Their estimates were at 4.2%. They took their estimates up to 4.2%. So they had 4.2% PCE inflation and a Fed funds rate at 10 basis points. And they thought that made a lot of sense. By December of 2021, they took their estimates up, expecting 4% GDP for 2022. The next 2 quarters were negative. Like, how do you, in one quarter, it's like they're day traders. The market was going up, so they're like, well, then GDP must go up. Like, you can't make this stuff up. Like, they've got 400 PhDs in that building, and they, like, couldn't get it more wrong. Literally, weeks before, not even weeks, like days before the next quarter, they upgrade, they have a GDP outlook of, they upgrade from 3.8 to 4%, and it came in negative. And it came in negative the next quarter. And it's probably coming in negative the quarter after that. And in that context, they still had the Fed funds rate at 0.1%, and they thought that maybe it would go up to less than 1% in the year. Then, you can't make this up, but in March, they cut their GDP estimates from 4% to 2.8%. So they nearly halved it after they got the negative data, and decided it was time to start aggressively tightening into a slowing economy, and catapulted their Fed funds rate expectations to 1.9%. So when the economy was rocketing, house prices were going up 70% in some areas. They're literally buying mortgage bonds to add fuel to the fire. And then when the economy starts to roll over, then they say, let's crush it and let's absolutely destroy demand, which is exactly what they did. And now we're working on our third quarter of negative GDP growth. So by June, they didn't get any smarter. They figured they should collapse GDP estimates now to 1.7. Remember, they were at 4 just a few months earlier. And increase the Fed funds rate projection to 3.4%. They couldn't figure out how to crash demand any more quickly than to step on the gas of a car headed into a brick wall. And that's exactly what they did. And then finally, yesterday, they decided with GDP now near negative for the full year, their estimates are at 0.2%, which means we're probably going to get the third quarter of negative GDP. Their view is, let's see if we can completely destroy the economy by increasing the Fed funds rate projection to 4.4% by the end of the year. And it's like teeing up your driver on the putting green. It makes absolutely no sense when you're a couple of feet from the hole. So last September, the Fed anticipated GDP would be 3.8% in 2022, and the Fed funds rate would be 1.9%. Instead, we have negative GDP and projections of a 4.4% Fed funds rate by year end. There are only two positives that can come from this level of incompetence. Number one, they can panic and walk it back quickly, or number two, they can panic and walk it back slowly. Time is running out as the credit markets are seizing up again. You're seeing credit spreads blow out. That's not good. The credit markets are closed. The IPO markets are closed. Just as Powell fought the last war in 2021, being too loose in the midst of inflation after his 2018 debacle of being too tight in a trade war, he's now making the same mistake for a third time, tightening aggressively into a declining economy. There is a reason you only get 3 strikes in baseball and you're out. Why the same doesn't hold true for Fed chairs, I guess we'll find out soon enough if he doesn't pivot quickly. The good news is that market participants are positioned for the apocalypse, high cash balances and defensives, as we've covered in recent podcasts and videocasts. Any reversal in policy outlook would force panic buying into year end. We'll likely know whether that is in the cards or not by Friday, by tomorrow. Here's positioning. Positioning hasn't been this negative since the 2008 financial crisis. The European debt financial crisis in the fall of 2011. You got a multi-year rally after that positioning. The credit markets crisis and oil crisis in 2015, monster multi-year rally after that, the pandemic lows, and now we're back at those levels. If you bought at any of these time periods, you made a boatload of money, even if it went against you for another few weeks or months. You wanted to be a buyer, not a seller. Cash levels the highest, higher than the pandemic lows, higher than the great financial crisis. We've covered these. They're under the bunkers, and this last one that I continue to recover, the recession expectations are highest since March 2009 and April 2020. The recession was already happening and the stock market bottom was already in. The recessions had not yet been declared, but they were happening. History doesn't rhyme, but it repeats. I continue to say this. I'm in the minority. It's possible this time will be the same, but we're cutting it close. So here we are. Recession expectation the highest, September in 2022. The bottom, we'll see if June holds or if they got to dip it below before Powell finally gets off the pot. So unfortunately, Powell seems like he'll need a little more shock treatment again, like in December 2018, before he wakes up and pivots. We'll find out soon enough if he learned anything from his first 2 strikes and pivots before his hand is forced or the decision is taken away from him. So Friday, I joined Hanadoba on Cheddar TV to discuss the market outlook, positioning, and history. We got more views on this interview than any other that we've ever posted on LinkedIn. So you definitely want to check this one out. There's a lot entrenched in that, and you'll see it in the comments. People are like, wow, I don't know if you watch your Cheddar interviews, but this was absolutely amazing. 10 minutes of stuff. So check that out. Same thing with the CGTN Africa with Hannah Viviers. Thanks again to Hannah, Samuel Kantai, and Lucia Moki. And over at Cheddar, Ali Thompson, Hanadoba, Ellie Park, Lisa Farkas, and Joe Cole. Again, one more data point that we look at, AAII sentiment. It's down to 17.7% bullish, 60% bearish. Retail sentiment is now lower than it was at the pandemic lows, which were 20.23, and the great financial crisis lows, which were 18.92. So, you can follow the crowd, but they'll put you in Wikipedia under the definition selling in the hole. CNN Fear and Greed also at Fear 31, And then let me just see where this came in today. The National Association of Active Investment Managers was at 33% equity exposure, but it flips over on Thursday afternoon. And my guess is it's lower, and I'm correct, 29.59%. So any positive news, and they'll have to chase hugely into year end. And that's that. So moving right along, technology earnings. Estimates for next year are down 3.5% in the last 60 days. The stocks are down anywhere from 10 to 20%. So that's same with communication services, 6.9%. The stocks are down. Some of them are down 40%. So that's overpriced in. And then finally, we have a question from Paul Smith. And it's about the Lovesac company. It's a furniture company. And I took a quick look. I like the way he's thinking about it. It's at $25 down from $95. They are interesting. I mean, I generally avoid these type companies that, he's only got 3 or 4 years worth of numbers here. It's a relatively new IPO in 2018, so it's not my cup of tea. But I do like it. I mean, in terms of the growth, and this definitely warrants a lot more research. The revenues have grown from, 100 million in 2018 to 500 million last year. They have kind of specialized furniture that has speakers in it. It's modular. It has storage in it. And I've always kind of liked the furniture business. Known a lot of people privately in the business that did very well. Huge margins in the business and etc. The reason it's probably got the stock overhang is because it's related to housing in the short term. And until we get some stabilization in rates and then the home builders start to get bid, this thing will probably be, trading with housing. So when you see the home builders, you can take a closer look at this. Home builders start to move, but you can see their gross margins have stayed in the mid 50s. It's just a high quality business. Their revenues are growing exponentially. I think they're trading at I think they were going to earn $4 next year, so they're trading at 5 times forward. So people obviously are questioning the margins because the costs are going up. So yeah, $4 next year, so it's trading at about 5.5 times next year's earnings. They're starting to generate meaningful return on capital in the mid-teens. Return on equity is in the mid-30s. So it's on the right track, and I think this one definitely warrants keeping an eye on and doing a lot more research. I think Paul did a good job pinpointing this one. And, like I said, probably not for me because there's not enough data and certainty in it. But I never go all into a position all at once or all out of all at once. So, you could probably start to find spots to build a small position if this one was interesting. Paul, and for everyone else, as always, this is opinion, not advice. Go to Hedge Fund Tips, click on terms. With that said, we're going to be back next week, same time, same place. I'd like to thank everyone for tuning in. In the meantime, make it a great one, and bye for now.